new power talk and a talk by the CEO Bombay Stock Exchange, Mr. Ashish Chauhan. I take this opportunity to welcome sir for today's event and quite thankful on behalf of IACA for kindly consented to be with us out of his busy schedule. Dear friends, Mr. Chauhan is a well-known figure, and I'm confident you all know him. Still, I would like to introduce him. But before I introduce, I would like to mention he has always been supportive to the initiatives of Indian Institute of Corporate Affairs. And whenever we have approached Sir requesting him to speak on our platform, addressing to the directors during our training programs, he has always been a part. Mr. Chauhan is a technocrat from IIT, and I am currently working as Managing Director and CEO of BSE, formerly Bombay Stock Exchange. At BSE since 2009, Mr. Chauhan has helped it diversify in different areas and become the fastest exchange in the world. Mr. Chauhan acted as the CEO of IPL cricket team in Mumbai Indians in its formative years and worked as the president and CIO of Reliance Group from the year 2000 to 2009. Sir is one of the founders at National Stock Exchange and is considered to be the father of modern financial derivatives in India due to his seminal work there from 1993 to year 2000. Sir is also the creator of Nifty Index and was in charge of creating the first screen-based trading. Mr. Chauhan has headed the South Asia Federation of Exchanges, SAFE, consisting of 20 plus exchanges. He is considered to be the foremost experts in the fields of fintech, transaction processing, corporate governance, finance, regulatory policies, business and technology, amongst others, and has widely spoken on various platforms, for example, UN, WEF, WFE, UNCTAD, OECD, Commonwealth, etc. Sir has been a part of policy committees of various ministries like Ministry of Finance, Ministry of MSME, CBDT, Reserve Bank of India, Securities Exchange Board of India. If I mention, Sir has won several prestigious Indian and international awards over the last 3 decades, including Mumbai Ratna, Digital Icon of the Year, Asian Banker, Top 50 CIOs in the world, etc. Sir has served on the board of prestigious Indian universities, including Indian Institute of Management, and also acting, which he has been recently appointed as Chancellor to the University of Allahabad. Sir is a distinguished visiting faculty at Ryerson University in Toronto and honorary professor at Nottingham University Business School. A book titled BSE, A Temple of Wealth Creation has also stands to his credit as a co-author. Dear friends, today we are going to discuss and listen to him with his experiences and expertise about the roles and responsibilities, liabilities of independent directors, and how they can be more effective in the boards for taking their respective companies to the next level. I welcome you, sir, and over to you for your discourse.
Thank you, sir. It's a pleasure and honor to be in front of you today. I hope I'm audible.
Yes, sir.
And basically, the way I look at this, the modern society is built on what I call the edifice of corporates. The corporates are very young entities in the annals of the history of mankind. Around 600 to 700 years maximum. There are proofs of some sort of corporates, not the limited liability, but unlimited liability corporates existing in Europe probably 600 or 700 years back. And in some ways, the modern development, modern prosperity is due to corporates. And that's where basically corporates are primary vehicles through which societies today operate their commercial activities, and also job creation, keeping law and order, because you give the jobs, people get established or invested into those societies, and that's how the corporates have played a great role, and probably they will play even greater role going forward in maintaining those societies, creating jobs, creating employment, creating wealth, and so on and so forth. And if you look at the philosophy, if you don't understand why corporates, it's very difficult to be a director, let alone independent director. And somewhere on the line, there is going to be a doubt in your mind as an independent director, even if you are trying to become a director, that why, I mean, what is a director, right? Why a corporate exists, and what is it that you need to do as a director, or what, if you're not a director, what is it that you need to expect from a director, from the company's perspective, from a shareholder's perspective, but also from, say, media perspective or a societal perspective. And that's where I think you need to understand the perspective of why corporates actually exist, how did they come about, and how they've evolved over so many years, and how in India it is happening. So that in many, many areas, India is a thought leader on corporate governance and so on and so forth. And if you don't know the same as a director, it would be what I call a little less of being a director if you don't understand the essence. And if you understand the essence, then my understanding is that whatever decisions you participate in, whatever activities you participate in as a director, or even as a person who is aware of the director's duty, it will actually help you perform that duty better, or make the directors perform their duty better. And that's where basically there are several issues which we need to worry about. And one of the larger issues in corporate governance for any director or anyone who's an observer of corporates is what I call asymmetry. The asymmetry is what I call the touchstone or a cornerstone of the corporate governance across the world. Usually, when you read books on corporate governance, you don't get to hear, even in seminars, what is it that the asymmetry as a regulator we try to overcome. And that's where basically the asymmetry of information is there, and asymmetry of power is there. These are the two asymmetries we try to resolve. Asymmetry of information is where you have insider trading laws, which you might have heard of. That asymmetry is in two parts within a corporate. There are insiders into the corporates, that is the employees, the management, the managers, also some of the people whom in India we know as promoters, or people who have substantial stake in the company as a shareholder, but also they participate in management in some way. They are called promoters in India. And so the independence of a director is in some ways independent of the majority shareholders or the promoters or the larger interest having people. And that's basically as opposed to, as I said, which is basically in favor of minority shareholders, right? And so in terms of the corporate governance, this is a very important issue to remember, that you try to reduce or eliminate to the extent possible asymmetry of information. Now, how does the asymmetry arise, and why does the asymmetry arise? The asymmetry of information arises because the insiders have a lot of information, right? The managers are entering into contracts on behalf of the corporate. Corporate is not a physical entity, right? It's a conceptual entity, it's a legal entity. It arises because the Indian Constitution has allowed us to create a new legal entity called company under Indian Companies Act, now 2013. Earlier it used to be Indian Companies Act 1956. And before that, it used to be the Companies Act 1950 of the UK. But effectively, the Indian Companies Act 1956 and later on 2013 allow us to set up a company which is actually not a physical entity. Of course, you can have a building later on, but it's actually a conceptual entity, and it is what we call legally a company. It is a it can be represented, but it cannot represent on its own because it does not exist in a physical sense. So that's why its agents, that is the directors, its management and other people actually represent the company in entering into contract, doing activities, employing people, going to courts, and so on and so forth, right? So effectively, the people who are running the company, their managers, their even people who give them directions are the board of directors. They give policies, even work on giving direction sometimes. And those people are also part of the, in a way, people who are insiders. And the insiders have more information because they have, at different levels, of course, they have different levels of information, while as the outsiders, people who are invested into that company but who do not participate in the management of the company, they have less information or very little information of, say, for example, if you're trying to enter into a very large contract with somebody, and it may affect the company's profitability materially, or do something which is large, then you are basically supposed to inform everyone, not only your management, not only your board, but also the entire society. That includes your other shareholders, which you call minority shareholders, but also people who have not yet invested in the company, or even media or the government, and so on and so forth. So that's where basically the asymmetry of information arises due to the insiders knowing more, being the agents of the company, who run the company, who enter into contracts on behalf of the company with outsiders, or doing some activity on behalf of the company with sort of on a day-to-day basis. That's why this asymmetry arises. And what are the outcomes of asymmetry? Why asymmetry is bad, and why should you not have asymmetry? Because in some ways, the modern corporates, as I started with, actually is a cause of greater good, right? They create wealth, they create jobs, they allow savings of investments of a general population into productive capital, which creates even more jobs, and so on and so forth. And that's where basically the society wants these corporates to run well. They also want the corporates to not have this asymmetry of information, or reduce the time taken from somebody within the company knowing about the information and the rest of the world knowing the information to the minutest minimum, the infinitesimal, the smallest portion is what the attempts of the regulators in the modern capital market system is, because literally millions of people are investing in those companies. And if somebody who has that privileged information, that extra information, based on which he or she ends up buying the stocks or selling the stocks of the company and ends up benefiting vis-a-vis others, non-insiders or minority shareholders, then it is basically in a way giving them unfair advantage. The insiders get unfair advantage. That can include even auditors, that can include even consultants or consultants' relatives. There are cases recently which basically force even the auditors' friends, relatives as insiders, and there have been cases in SEBI which have now been initiated on that basis. So effectively, if you look at it, the asymmetry of information allows some people to take advantage and sort of make money at the cost of other general people, non-insiders, minority shareholders, non-majority shareholders, non-promoters. And that's where basically the asymmetry of information is a problem case for across the world. Literally all regulators try to regulate in some way, and that is known as insider trading. And there are many other regulations relating to when to inform the exchanges, how to inform the exchanges, and so on and so forth. And for that, BSE has created a platform for listed companies to report all their material activities in addition to their quarterly results or annual reports, any material event that happens, including change in directors or anything, that has to be reported to BSE's platform within a particular time frame for each information. But as and when it happens, within a very short, reasonable time, that information has to be divulged, disclosed to the exchange platform immediately, literally As soon as you press enter, it goes to the exchange website and also Twitter and Facebook and everywhere, so that people are able to consume that information, and then they come on par to some extent with the insiders. And that's basically the purpose of the regulations. That is the purpose of the regulators, that information gap that exists between the insiders and outsiders, the majority and minority, or management and non-management, is brought down to the minimum in terms of the time as well as the extent of information, so that nobody can take advantage of that. And so as an independent director or as a normal director, every moment you should be aware in your back of your mind that should we report this or not. And my advice to everyone is that there is no harm in over-reporting. Whenever in doubt, report. Whenever this question comes to you saying, should we report or should we not report, whether this is material or not, in my opinion, you should report. So that later on, there is no liability on you or on the board as a collective, or now, because other criminal liabilities can be imposed on every director for negligence or misrepresentation or many other things. My request would be, for your own sake, if you're a director, you must learn to ask the management to report instantly, immediately, and as soon as possible, without wasting any time. As and when any material event happens, or even if there is a doubt about materiality, please report, so that there is nobody who can chase you later on about this asymmetry of information or insider trading regulations later on. So that is basically one part of it. The second part is even more interesting, which is called asymmetry of power in my own parlance, although you wouldn't see this discussed ever in most of the corporate governance books, because most of them are written in Western countries. And although the regulations and regulators try to resolve this asymmetry, they have not explicitly mentioned that. But asymmetry of power is the insider trading part of it. Asymmetry of information is the insider trading part of it. And asymmetry of power is basically about the insiders trying to take advantage of their position as being insiders and also agents to enter into contracts or to do something to their own benefit, to extra benefit vis-a-vis the other shareholders or even the company itself. So that would include, for example, related party transactions, that some companies, their management or their promoters may enter into agreements with their own subsidiaries or sister concerns or another entities of the promoter at a more favorable term to the promoter. That could be in form of a merger, it could be in the form of providing of services or anything. The new Indian Companies Act, which is pretty much a rare situation across the Companies Act across the world, is that now it's to reduce that power so that the management or the promoters or insiders don't end up taking advantage of the company vis-a-vis the rest of the company as well as its shareholders. There is a concept of a majority of minority, that wherever the promoters or the majority holding shareholding people who are having their decision which may affect their well-being or their contracts or contracts in which their related companies or related entities are transacting, you need to basically take approvals from the minority shareholders only. Majority, that people who are interested should not vote for that resolution in the AGMs or otherwise. And I think it's a very beautiful way to kind of reduce or eliminate to some extent the asymmetry of power, because the misuse of power, as we know in democracy, and this Corporate Governance Companies Act, it's basically about also corporate democracy. It's what I call proportionate democracy, not a one person, one vote democracy, but proportionate democracy. At the same time, if anyone is trying to misuse that proportionate democracy, then this clauses of new Indian Companies Act 2013 kick in, which is what they try to remove or eliminate, is asymmetry of power. So these two things, if you remember, as asymmetry of information and asymmetry of power, broadly speaking, you have covered large ground in the corporate governance as an independent director as well as a director itself. But because if you are an independent director, then there is a concept of independence that needs to be sort of adhered to. SEBI has regulations. Again, if you look at the philosophy, the independent director is supposed to not be connected any pecuniary way with the company in any capacity. So again, basically that person has to worry about the interest of non-promoters, non-management, and so on and so forth. That doesn't mean you are at war with the management or you are at war with the promoters. No, then the company cannot run. But independence is independence of thought. To the extent company needs to run smoothly, it must run. But if it is trying to violate the principles of corporate governance, whether it's asymmetry of power or asymmetry of information or any other laws of India or any other laws anywhere, then it is your duty as an independent director to point this out, to get some legal opinions, to get it checked whether this is correct or not, and then only you allow it to move forward. So for me, again, it's a easy rule of thumb that when in doubt, ask questions to the management, to the promoters, to the board, to the company secretary, to the CEO, to the managing director, to any other director, and ensure that basically the company does not violate any law, the board does not violate any law, because the liability now can be even criminal liability on an independent director, and that's where you need to be very, very, very careful in not adhering to the regulations. Many times people take it very casually, and earlier days when there used to be manual filing of returns and all, most of the time it was very difficult to retrieve the files from the government godowns, from the MCA's godowns and all. But now with electronic filing, it becomes very easy to retrieve whatever that you have filed. And if it is wrong or if it is found to be a violation of any law, it has to be basically, it may bring disrepute to you as an individual, but also disrepute to the company. And it may also attract some criminal liabilities in addition to civil liabilities. So be careful as an independent director. I'm not trying to frighten you as an independent director, but you need to be very, very aware that somewhere on the line, anything knowingly or unknowingly that is happening in terms of the asymmetry of information, asymmetry of power, violation of any laws, because for me compliance is difficult, but non-compliance is not an option now because of the automation. And that's why every board, every management has to take their compliances, whether it's RBI regulations, whether it's SEBI regulations, whether it's Ministry of Corporate Affairs, whether it's municipal regulations, whether any other laws or any other aspect of laws in India, you must learn to track them, to comply across all your branches, all your sort of offices, all your plants, all your machineries, and so on and so forth. So be careful and try to sort of work on that. The last portion which I would touch upon is what I call the concept of de facto versus de jure. That you may understand the law. You may also try to be legally correct, which is what I call de facto, and de jure. But if you are not morally correct, because if the board ends up taking decision which allows some party, whether it's promoters or majority shareholders or management or even none of them but somebody else, at the cost of its shareholders, then again you are doing a disservice to the shareholders whose interest you are supposed to protect, to the society who is having some expectations to you on you. And that's where basically you need to be very mindful of this concept of de facto versus de jure. That is, you may be legal and still the SEBI or the Ministry of Corporate Affairs or exchanges may not allow you to do things, even if it is legal, because it's against the interest of the small investors. or in some other way it is against the interest of the society at large. And that's where basically you need to be aware that not only that you need to be legally correct, but you have to be morally correct while making decisions as a board, as a collective, but as an individual. If you have not raised this issue of the morality during decision making, uh, when some immoral, unethical decision is being taken, uh, either against shareholders, against the country, against the society, against any other things, then again you may be liable for, in some ways, disrepute, personal disrepute, or even sometimes prosecution. So be aware, because there are recently many cases where SEBI has not allowed the legally correct, at least technically correct activity to take place, because they believed that the small shareholders' interests were being jeopardized. And ultimately, the SEBI's role or ministry's role or government's role is to take care of the minority interest, the shareholders' interest. Now, BSE has almost 7.75 crore investor accounts. And all of them are investing in India's capital markets with a market capitalization of almost $3.2 trillion, is because they have that trust that their interests will be protected. And whenever the decision has to be taken by all the boards, board of directors, where independent directors also participate, it will be fair and will always be truthful, be legal, and also be equitable. And that's where I think we all, people who are sort of invested into the company in some capacity as directors, independent directors, or otherwise, we must ensure that we take care of this information asymmetry, power asymmetry, and de facto, de jure kind of a framework, ethical versus unethical, moral versus legal kind of debates. And whenever in doubt, please disclose, reduce that asymmetry, and also reduce the power. Or whenever, again, I would say, whenever a company lists on BSE, I try to tell the management that if you have to take a decision, take decisions in favor of the small investors, the minority, not in your favor, even if it is allowed legally. Then you build your reputation. And when you build your reputation, many magical things happen. So with that, I will just conclude the first part of my interaction with you. But we will have some more interaction while having that question answer session. So I hope this was useful. Thank you.
Thank you, sir. Thank you so much for a very insightful, very comprehensive, and thought-provoking discourse. Now, if you allow, I would invite participants to raise questions so that we can have some interaction. Friends, I invite you for the questions. Who would like to go first? Yeah, Mr. Ashok Jain. Can you unmute yourself, please?
Yes, sir. Thank you. Thank you very much. Good afternoon, sir. I think very nicely explained the intricacies of liabilities of independent director. So my question to sir is that even after getting recorded certain non-compliances by the board or maybe by the promoters, even something goes wrong. So ultimately, what would be the liability of an independent director instead of or in spite of the fact that he has raised the issue and got it recorded, sir?
No, it's again, as I told you that if you have at least raised the issue and it's minuted, usually when it goes to the sort of legal authorities, whether it is SEBI or STAT or Ministry or NCLT, you'll be able to show to them that you have, as an independent director, raised this issue, and despite that, the board has taken a decision or the management has not behaved as per what you have raised. Then you basically end up getting a what I call cleaner cheat, provided there are other circumstantial evidences which also go in that in a consonance with that, because sometimes people may also oppose the same thing once, but may still agree while it is being voted upon. And so those things
Yeah.
the court and the authority will take into account before passing their judgment on specifically for that particular person. But if you have not done it, then clearly you run the risk of being clubbed with other people who have violated, right? So you need to, I mean, you have a responsibility to the company, but you also have a responsibility to yourself to save yourself, right? So that's where I think I would urge every independent director and every director for that matter, because not every director would agree with the management, even if they are part of the promoter groups, or even if they are part of the management. It's not that everyone sees eye to eye. And my request is every time you have a doubt, please raise it, ensure that it's minuted well. And whenever the voting happens, don't try to be under what I call आँख की शर्म कि मैंने आवाज उठा लिया बट ठीक है अब तो चलो अभी मिनट कर लो and then we will vote together. Don't do that. I don't think it will stand scrutiny. If you have made the noise but later on you agree to the wrong proposal, right, or unethical or immoral or illegal proposal, then clearly I don't think the authorities will grant you any leeway there.
Very nice, sir. The only thing is, in case you have raised the issue, and sometimes there would be situation that it will not be recorded, for example. So what alternative I have as an independent director is that once the minutes are circulated, I can always send a mail that I am not agreeable to this particular decision. That would be there in the records, because there is possibility that if they want to do it, they may not record your observations also. Okay? In situation, alternative is that you can always send a mail about your views and your agreement on that particular decision, isn't it, sir?
I agree, absolutely, and probably you might have to go a few times better by reporting your disagreement to the exchanges also, and also to the MCA and all, so that in some ways you've done your duty. Otherwise, what happens is you've sent them the email and again it is kept quiet. It becomes a sort of a place for you to go behind, sort of take shelter under, saying I had sent the email, but they may not have received, they may not have read, and they may have certainly acted on, they have not acted on it. But if you have represented that this is the thing and it looks material to me and I disagree, and those mails you have or some representation you have made to respective authorities, then what happens is you have created a much better sort of case for yourself for future. And the outcome is that probably they may not want you any longer in the board. And that, I think that risk we all have to take. I think we don't have to be on the board where our conscience doesn't permit, or that board puts us in trouble even legally and criminally. I don't think we should be in those boards anyway.
Great. Can we have next question, please?
Good afternoon, one and all, and dear Ashish Chauhan, sir. I am Saravanan here from Singapore. It was great pleasure to have your presence here. I have two basic questions. First one is related to BSc. So you've been in BSc in a question for the last 12 years. A lot of changes that you brought in during this period. So what's our next 5 years, in this digitalization era? So what you are planning to have for the next 5 years in BSc? And the second one is, being as an independent director, we have a certain duration to serve for this particular corporate or company. So what's your opinion or suggestion when we have a exit strategy? So when an ID exists from an organization, so what he needs to be taken care of, or what's the best way to have an exit? Thank you, sir.
I think basically the 5 years of BSE, when BSE, as you know, was set up in BSE was set up in 1875, right? So it's almost, it's completed 146 years on July 9th. And so it has kind of lasted very long. The prime function, see, you can always say BSE as a business, what it wants to do is very different from BSE as a mother of capitalism in India, right? An entity which can basically, which has helped India catalyze $3 trillion of wealth. $3 trillion, now $3.2 trillion, is literally 33% of India's total wealth, is now out of basically things, companies listed on BSE. Why that wealth has been created in last 146 years is because it has been able to create that trust in the investor's mind that if you put in your money in companies, and if you're sitting in say Singapore today, you are putting money into Indian corporate, you know fully well, at least you have tremendous confidence that your money will not go wasted most of the time. And if the company makes profit, you will have that claim on the dividend of the company, and company will give you information on time and so on and so forth, right? And all sorts of information on time. So that trust that has been created is what has made basically BSE catalyze that $3.2 trillion of wealth. And our hope over next 20 years is to go to $20 trillion of market capitalization for India's companies, not BSE. BSE is only a platform on which these companies come raise their funds. There are trading of those stocks that happen, but ultimately no country can prosper only on the back of trading. The countries prosper on the back of wealth creation. And our understanding is that the capitalism, the concept of capitalism when BSE was set up 1875, over 146 years has changed drastically. Earlier, you had to put in a lot of capital to create more capital. That is the concept of capitalism which Karl Marx defined. Karl Marx defined capitalism as a concept as opposed to communism. That basically if everyone works together and gets what they want is communism. And capitalism on the other hand is that people who have a lot of money, they end up making other people work and then make more money. That is capitalism, right? The modern capitalism actually doesn't require a lot of money to create more wealth. Because of the technological changes that are happening so fast, even with putting little money, a lot of brains, you are able to now create huge amount of wealth in a short time. We have seen it in America, in Facebook, in Google, in Tesla, and many other areas. But even in India, we have seen it in Infosys. We have seen it in recently Paytm or Zomato, and so on and so forth, right? So the modern capitalism allows the creation of huge capital at by investing little capital, and that which in India used to be capital-wise short perennially. Now, at least little bit capital we can all invest into newer companies, and they may create a lot of wealth going forward. So our framework is to ensure that Indian companies which require funds do not get funds from private equity or angel or venture capital. We should be able to raise funds for them from smaller investors, people who they don't know, like in IPO. And that's why VS has created platforms like SME platform, the platform for startups. Even VSE has incubators in Mumbai and Varanasi both. And so BSE is trying to basically create the new framework of capitalism, which I call capitalism without capital. But today the world is in a place where it's going to create a huge capital, huge wealth over next 50, 60 years. And India is in the right place. If we have a methodology for young companies to come collect funds from unknown people, and some of them will become large, give a lot of jobs and so on and so forth. So that is basically for me the hope for BSE, that the way it has helped India create $3 trillion of wealth in the last 146 years, in next 30, 50 years, it will help India create probably $20, $30 trillion of more wealth going forward. And that is our hope. Let's see how far we succeed. But whatever way we go, if India has to progress, the corporate governance has to be of top notch. Today, India is considered among the top 10 countries which provide minority protection in corporate governance. We are ahead of US. We are 7th in World Bank ranking in terms of the minority investors' interest protection. So already we are far ahead, but we need to be continuing to evolve in a way that we continue to provide better corporate governance, more information, better decision making, so that the companies in which people invest money in, they know that it's not siphoned off in some ways, or somebody doesn't benefit illegally or immorally out of their company's interest and so on and so forth. The second part which you had was on what should be the exit strategy of the independent directors. I mean, it's an interesting question to the extent that I have not sort of applied a lot of thought to that. But having said that, I think one of the interesting aspect of it is that an ID, independent director, or even a non-ID, when a shareholder director, can have liabilities which may arise out of his or her tenure during that period, even later on, after 5 years or after 10 years. So you need to basically worry about, in case those liabilities arise or those court cases happen, what will be your way to fight them? And so that there are liabilities related insurance that is available by commercial insurance companies that provide. And when you are already in ID, you are already on the board, you might like to consider taking those liability insurances for board members, so that, and it should be such that even later on, when you stop being ID, protection should remain, because the liability will arise out of your being the director for your tenure, not outside the tenure, right? And that's where I think you are going to have to worry about that immensely. So at least before you exit, you should get this done. Of course, the other exit strategy has to be that anytime when you are already in tenure, you must ensure that the company behaves well legally, morally, ethically, and ensures that nobody gets undue advantage, whether it's promoters, managers, or any other third party, which is basically you are able to show it to the world that it's done at arm's length and reasonable cost and so on and so forth. And it's fully done on all legal compliance that have been made. Then I think, broadly speaking, you should not worry when you exit.
Okay, thank you, sir. Can I now request Mr. Abhay Shankar to please come in and unmute himself?
Yeah, good evening, Mr. Chauhan. Thank you very much for a lovely talk on the role of the independent directors. I have actually two very specific questions. Number one is, can an independent director buy shares of a listed company? And of course, taking care that he buys it outside the blackout window and he complies with the 2% limit, etc. Because I was told that, although the regulation is a little silent on this, and but morally, independence will be lost if an independent director buys the shares. What's your view on this, please?
I think legally what you said is correct. And broadly speaking, if you continue to establish in your behavior that you are independent, not, you have to be not independent of the company, understand? You have to be independent of the majority shareholder. Many times what happens is we tend to take the word as independent, means you are independent of the company, then you will ensure that the company doesn't run. That is not the purpose. You have to be independent of the majority's influence on you, the majority shareholders' influence on you, right? So as far as you are doing that, there are many companies which provide even stock options, which provide even commissions, and so I don't see that to be an issue as far as you continue to kind of show in your behavior that you are independent of the sort of influence, undue influence. I won't say influence, but undue influence, so that you allow the majority shareholder or a promoter or management to take undue advantage of the situation, and that's what I think you should keep in mind.
Right. Thank you very much. In fact, what you said makes a lot of sense, and in fact, if the independent director also legally and properly acquires some shares, he actually is reducing the influence of the majority shareholders also, because he himself becomes a shareholder to some extent, and he's interested in the well-being of the company. So thank you very much for that answer. My next question is that this is a real case. There was an independent director appointed by the company, and within 1 or 2 months, both the independent director and the company jointly discovered that he being on a board of an NBFC would actually slow things down for this company in terms of getting loans from the banks, etc. The bank procedure becomes very, very tedious. So he offered to resign. And he did resign. His offer was accepted. He was resigned. But he is a very good person, a very useful, very knowledgeable person. Now he continues as an advisor to the board. And he, on invitation, attends all the board meetings. And we are very happy about it because he's a professional and he's been with the banks actually earlier on, etc. But now there was a question raised by one of the directors saying that there is a law that once an independent director ceases to be an independent director, there is a 1 year or 2 year cool-off period, to which the company secretary and the legal opinion came in that, look, that is true for when an independent director serves the entire 3-year term, then you have to give it a break to ensure that there's no nexus formation, etc. These are little checks and balances that the regulators have put in, and therefore that is true for that. But if an independent director has, because of some specific reason, he has resigned just in barely 2 or 3 months of his serving the board as an independent director and continues as a board advisor, I don't think there's anything wrong with it. No regulation is violated. Sir, what is your view?
This is a very technical question, and I will have to actually see the case law and all things like that. But I would, on a prima facie, based on what you have said, I would say that don't try to creatively interpret the law saying only if he has completed 3 years, then he should have 1 year cool off. And if he has completed 2 years, 264 days, and 23 hours, he doesn't require that cool off period. But you say no, but 3 months is different from 2 years and 264 days. But slowly you bring it down to 263, 262, 263. It will come down to even 1 day also. What I'm telling you is a lot of people tend to overtly interpret to suit their current interpretation of or their current situation. One of the requirements, I would say, as a what I call as a knowledgeable, as a person who is aware of what is happening, would be saying, boss, why are we trying to do this? Why does he have to attend the board meetings? Why does he have to be an advisor to the company? I mean, what is the point, right? It's that before he joined also, the company was running. After he joined also, company is running. Why would you want him now? When let's comply with the law in letter and spirit both. Don't do, I mean, in my opinion, this probably there is no such exemption which is saying that if a person does not complete 3 years, he can immediately become sort of having pecuniary benefit. I have my doubts on. But if the law specifically says, don't interpret otherwise.
Right.
Sir, I will compliment
so
what
much.
you have
Thank
said.
You very much. Very helpful.
I will compliment to what you have said.
Thank you, sir.
Thank you so much. Can we have Ms. Jyoti Sharma with her question?
Gupta ji, before that, I just wanted to compliment whatever he said here. Even if an independent director works for 1 day and resigns, that is treated as a term.
Absolutely.
It is not necessarily it is 3 years. So the independent director, whoever has joined as an advisor, it is clearly against law also. That is questionable.
Thank you very much, Mr. T. Rao. Thank you so much.
Yeah. Thank you, Mr. Shankar. Yes.
Thank you, Mr. Rao.
Yes.
Can we have Ms. Jyoti Sharma, please?
Yeah. Good evening, sir. I have a small 2 questions. One is
Can
to
you
a
switch
question.
on the video?
Yeah. Good evening, sir. I'm Jyoti Sharma. Like to a question asked by an earlier participant you said that, if there is any non-compliance, it should be reported to the stock exchanges as well as SEBI. But the consequence can be that the company may not like you to be on the board after that. But the thing is that one is I just want to ask whether the company can remove independent director before his term is over. And the second question is, I just wanted to know for directors' liability insurance, is there any benchmark for which a company should be taking, like, for the
I think in some ways, before reporting to the exchanges or any authority, you should give a reasonable time to company to comply with the law, right? So that it shouldn't be that every moment, there is an animosity or an antagonistic relationship between management and independent director is not a good idea. You are not trying to hurt the company, right? So let us understand that first, that you are trying to only protect yourself in case of something untoward happens later on, and you come to know, you pointed out, and still people are not kind of doing it. Either they don't want to do it, or they cannot do it, or probably they don't have intention to do it. Whichever way, you must give some reasonable time, some ways to remedy the situation. And if they don't, then of course you have to take the stand or steps which you need to take to protect yourself going forward. In terms of the benchmark of insurance, I think basically depending on the size of the organization you work for as a director, you will have to basically take collectively a decision of what kind of potential liabilities happen and whether the organization can afford the insurance for that. Sometimes the organization may not be able to afford the premium for that, right? So you'll have to be kind of a reasonable in figuring out how this happens. And of course, in that also, it should be done to only protect and not to earn out of that insurance later on, because then it will become another pecuniary benefit. When there are insurance contracts which are structured to give you compensation many times. So don't indulge in those. It should be purely a protective kind of a framework, and it has to be commensurate with the company's size, company's profits, company's revenues, and it has to be collective but a reasonable decision on behalf of the board.
Great. Sir, one final question. Just taking 2-3 minutes of yours. Arun S., would you like to go, please? Mr. Arun S.
Yes, yeah. So I just have a question now. As an independent director, being part of the board, one approves a capital budget. But when it comes to question of choosing specific suppliers for specific equipment, the decision is left to the operational management. Now, in such cases, if a fraud occurs, is the board still responsible for it? Because once if you ask a lot of questions, then it is seen as you are interfering with the operational management. That's my question, sir.
It's again a good question because I think it's a very nuanced, very practical question, that if the board is deciding on policies and board is deciding on the framework, should board overlook the obvious fraud? Board shouldn't look obviously the fraud that is taking place. So if you come to know, you must ask those questions. Your job is not only to create policies, but to also oversee as a group, as a board of directors, as a collective, but also as an individual. You should not be sort of going away from your duty when you come to know. If you are not aware, then it's a different issue. But once you come to know, or you are supposed to know, obviously, that those material contracts will come to the board. And if there are obvious frauds that are taking place, you must ask those questions. And I don't think you can kind of wish it away by saying that I was not aware and there was a reasonable way in which you could have become aware. Then you should have become aware and you should have asked those questions. That's how I would put it. Because by that logic, no decision of the board will be actually be implemented only by the management if they know that the board is kind of keeping itself away from asking tough questions.
Thank you, sir. Can we take one more question? Mr. Hanumandalu, would you like to go?
Yes, sir. Sir.
Sure.
Sir, good
A
evening,
very
sir.
quick question, please.
Sir, good evening, sir. Sir, sir, independent directors are not part of
Can you be a bit loud, Mr. Hanumandalu? Can you be a bit loud, please?
Am I okay now?
Yeah.
Yes, sir.
Sir, independent director is not part of active management, sir. A function, not functional directors. Then, if any complaints shortfall is there of any administrative faults or frauds happen, why the independent director should be held responsible to regulators? This is my one question, sir. And one more thing, sir. As you said, the Indian capital market valuation is about $3.3 trillion. And if it is delivery based market is better, sir. Unless the speculation market is creating lot of overvaluations or undervaluations. Recently, we have seen the shares are quoted less than the issue price. It is giving lot of it may lead to losses to investors. It will discourage investment. Real investors who invested money in mutual funds or directly to IPOs also, sir. This is my opinion, sir. Thank you, sir.
Good. I think in some ways, if the independent director should know, then the independent director will be held responsible in cases of obvious frauds. In case the fraud is very elaborate and there was no way the independent director or any other director would have known, then it would have been a different issue. But broadly speaking, it will be very circumstantial. It won't be that why independent directors should be made responsible because they are not part of the functional management. But there are many shareholder directors who are not part of the functional management. Many of the promoters don't actually act as the CEOs or managing directors, right? So I don't think that is something where you can take shelter under when things come to that in terms of criminal liabilities or frauds or something. But literally, you will have to prove beyond reasonable doubt that there is no way you could have been aware or you could have become aware on a good analysis of the activities of the board papers and even what you get from the markets in general and so on and so forth, that there was no way you could have figured. Probably the authorities may consider your perspective in terms of your opinion on delivery-based markets being better. And then second opinion was that if the company shares are quoted at below the issue price or below the face price, it is bad. See, what happens is when you start a business or when you invest, you don't know. It's like real estate. You buy a house in say 10 lakh rupees and after 3 years it becomes 5 lakh rupees. It's the market price. Similarly, when a company starts and its business goes down in some ways, knowingly and unknowingly, the prices will go down. So for me, that's a totally different issue vis-a-vis the delivery-based market versus speculative market. There is a over trading, as I would put it, across the world because of automation of transaction exchanges. And that, I think, in a way, provides a illusion that stock exchanges are only for trading and not for wealth creation or for corporate governance and all. And I think in some ways, exchanges, regulators, they have, because of the way the modern technology has evolved, the trading has kind of taken front seat, and the corporate governance and wealth creation aspect of exchanges, which used to be the primary function, in my opinion, it's still the primary function, that no country can prosper out of pure trading or pure speculation. No society should be sort of tolerating such thing. But those are personal opinions. We have to be aware of the realities and work accordingly, right? So effectively, I try to do my job at the cost of sometimes people criticizing me, even at regulatory levels or even at in media, about that why you are focusing only on corporate governance and wealth creation and not on trading. But for me, I mean, if India has to prosper, India has to progress, we are not a developed country.
Yes.
We have a long way to go, and if we get sidetracked, into unproductive speculative activity, then we are doing a disservice to our own potential, and that is what my personal opinion is. But that doesn't mean we have to ignore reality. Reality is that they trade a lot, right?
Gupta ji, do I have time to put one question?
Sure, sure.
Okay, sure.
Sir, normally in the board meetings, the managing director signs one legal and other compliance report. He places to the board. In one company I have seen, the managing director certifies that the compliance is materially complied. Is there any material compliance? In fact, when it is a legal compliance, it has to be 100%. But will that be sufficient?
No, I agree with you. See, material compliance, which means usually they would try to say that others are not having any penal clauses or penal things applicable. Probably they might mean that way, but I agree with you 100% that there is nothing called partly compliant. Either you are,
in fact, it's a large company.
Compliant.
They write two things. One is we have materially complied with everything, and also say we have relied on the, the certificates given by the departments. That is okay. They can rely, but this material thing has to be questioned. Okay, thank you, sir.
So I have one event starting in, actually it started at 6, so I need to drop out. But I hope this was useful, and thank you very much to IIC and all of you for being patient listeners. Thank you.
Thank you, sir. Thank you for your time and patiently answering to the questions. It was a wonderful talk. Thank you so much. And I would like to say good evening to you and to all the dear participants for staying safe. And we'll be joining next week for another event. Thank you so much.
Thank you, sir. Thank you, sir.